In this example, we are going to account for all the various stock-related transactions that a company can undertake during a period of time. Our company, in this example, is going to be Squeeze Toy Co. And in the first entry that we have on January 1st, their board of directors has authorized the issuance of 500,000 shares of $1 par common stock and 50,000 shares of $100 par 5% preferred stock. Well, what is happening in this entry? The board of directors says you can, if you wish, issue this amount of shares at this stated par rate, but we're not actually issuing anything, so we're not going to receive any cash. People are not paying us any money to buy ownership in our company, so our paid-in capital or our equity accounts are not going to change. At the point of authorization, when the board of directors says you can issue stock, you're good to go, but it's not materially changing the financial position of your company. So no formal journal entry is required for a stock authorization. You can, however, add a memo into your ledger, and to do so, you simply write memo in the date section, and in the description at the bottom, write in the number of shares that are being authorized and the type of stock that you have. So here we can say that we authorized 500,000 shares of common stock and 50,000 shares of preferred stock. On January 2nd, we're going to actually issue some of those shares that were authorized on the day before, and this entry is going to change our financial position because we're actually issuing it, which means we're going to have to record an entry. On the 2nd, Squeeze is issuing 20,000 shares of $1 par common stock, and they're doing so at a market price of $15 per share. So they're charging $15 a share for this common stock, even though the par on it is only $1. Well, the first thing we need to do is denote how much money we're taking in. And to do so, since we're the ones receiving the money, we're going to increase our cash account by debiting it. How much cash are we going to receive? Well, we take that, we find that number by taking our shares issued and multiplying it by the market price per share. We are issuing 20,000 shares at a price of $15 each, which means when we multiply 20,000 times 15, we're going to come up with $300,000 in cash we are receiving from the issuance of this common stock. GAAP says that because we have a par value, we have to separate our equity into the portion of that $300,000 which is attributable to the par value of the stock, and the portion which is in excess of par. So the portion that goes towards the par value of the stock goes into an equity account, which is common stock, and typically you would write a dash and denote the par level of the stock, because you could have different types of common stock with different pars, so you can differentiate them if you do that. So we have common stock, $1 par, our equity account. We find how much of that $300,000 is attributed to the par value of the stock we're issuing by taking the number of shares issued and multiplying it by par price. So the number of shares we're issuing is 20,000. The par price of each share is $1. And if we take 20,000 and multiply it by 1, it's 20,000. So $20,000 of that $300,000 we're receiving can be attributed to the par value of the stock that we are issuing. A whole portion of that then is therefore in excess of par, and you record that in your paid-in capital in excess of par account for common stock transactions, which I am going to abbreviate to PIC Common, PIC-Common, also an equity account. And to find how much of that $300,000 was paid in excess of par, we have two methods to do it. You can either just take the $300,000 you're receiving and subtract the $20,000 that was going towards par, and I'll tell you that $280,000 of that payment was in excess of par. Or if you want to be more thorough, you can take the number of shares you're issuing and multiply it by the premium that your shareholders are paying for each share. So if we have a market price of 15 and a par price of 1, that means they're paying $14 a share more than par to acquire them. And we can math that out by taking the 20,000 shares that we are issuing and multiplying by, in parentheses, our market value of 15 minus our par price of 1. And when we do that, it comes out to 280,000. So you can check your work to make sure you have the right number there. And in the description, you would say that you issued 20,000 shares of $1 par common stock at a premium. Moving on to our next entry on January 3rd, Squeeze is going to issue their other classification of stock, their preferred stock. They're issuing 15,000 shares. These preferred shares have a $100 par, and they have a 5% stated rate. The stated rate is only there for the purpose of paying dividends. It doesn't matter for issuance, so for right now we can ignore that 5%. But what we do need to know is, even though $100 is the par, what price are we actually issuing these shares for? And we are issuing these shares for a market price of $200 per share. So on January 3rd, when we record this entry, the setup is going to look just like our previous entry up here. We are going to debit cash for the actual amount we are receiving by issuing these preferred shares, and to find that, you take your number of shares issued times the market price you are issuing for. We're issuing 15,000 shares, and the market price that we are issuing them for is $200, which means we are bringing in $3 million from the issuance of this preferred stock. We have to separate that in the portion which is attributable to par and the portion which is being paid in excess of par. So our first one is going to be a credit, which factors in how much of that $3 million we raised from issuing $100 par preferred stock can be attributed to the par value of that preferred stock. You take the number of shares issued and multiply it by par price. So we issued 15,000 shares. Each share has a $100 par price. That means $1.5 million of our issuance can be attributed to the par value of our preferred stock, and the remainder of it, therefore, has to be being paid in excess of par. So we are going to put that into our paid in capital in excess of par preferred account, or our PIC preferred account, and you can find that value by taking the number of shares issued and multiplying it by the market price that you are charging less the par price. We are issuing 15,000 shares, and if we multiply that by the difference in parentheses between the $200 market price we are charging and the $100 stated par price on our stock, comes up with another 1.5 million in our debits equal our credits, so we know we're good here. We issued 15,000 shares of $100 par preferred stock at a premium. Our next entry is occurring on February 1st, where we're issuing more common shares. We're issuing another 50,000 shares of common stock with a $1 par. This time, the market price is going to be $20 per share. Well, we're still issuing common shares, and we're still doing so at a price well in excess of our par, which means we're going to have a debit to cash to account for the amount of cash you received, and then we're going to have two credits, one that is the portion that goes towards par, and the other one is the portion that goes in excess of par. So that entry that we just recorded on January 2nd is the standard entry every time you issue common shares at a premium. You're always going to have one debit to cash. You're going to have a credit to common stock and par value for the portion that goes towards par, and another credit to your PIC account for common stock, which is the portion which is in excess of par. So same math is going to apply. You take your number of shares issued, in this case 50,000, and multiply it by the market price. We're issuing these shares at $20 a piece to determine that Squeeze is going to bring in $1 million from the issuance of these shares. Of that $1 million, what portion can be attributed to the par value of the stock? Well, you take the number of shares being issued, 50,000, and you multiply it by par value, which is still $1 par. $50,000 of that issuance can be attributed to the par value of our common stock. And the remainder has to be going into our paid in capital account, which we can find by taking the number of shares issued, 50,000, and multiplying it by the difference between our market price of 20 and our par value of $1. So we're getting $19 in premium per share on the 50,000 shares that we are issuing, which means our paid in capital on this transaction that is in excess of par is going to be $950,000. And here we issued 50,000 shares of $1 par common stock at a premium. In our next journal entry, we are buying back some of these common shares which we had previously issued on March 1st. So Squeeze is buying back 10,000 shares of its $1 par stock, and they're doing so at a market price of $18 per share. So yes, the par is $1 in this March 1st entry, but we are paying $18 a share to buy it back. Well, what do you call shares that you have bought back from the public? That is, in accounting terms, treasury stock. And we're going to call this account treasury stock common because we're buying back common shares. And it is a contra equity account going up. To find how much you are going to debit your treasury stock common account for, you take the number of shares you are purchasing and multiplying it by the market price that you are paying to buy those shares back from the public. So we're buying back 10,000 shares. We are doing so at a market price of $18, which means our debit to treasury stock common is going to be for $180 grand. And what are we giving the people to buy this back? We're going to give them cash. So our credit to cash has to be for that same amount, that same $180,000. And here we can say that we purchased 10,000 shares of treasury stock. In our next entry, we have on March 3rd the declaration of dividends. So at this point, our board of directors are saying we're going to pay a dividend in the future, but we're not actually paying it today. So on March 3rd, we need to record an entry that establishes the fact that we are going to withdraw money from the business to give to our owners and creates the liabilities that we are going to have for the dividend payments which we have to make at a future date. So on March 3rd, the first account we're going to use is a debit to cash dividends. And we know the total amount of money we are going to be taking out of the business when we eventually make this payment is going to be equal to the portion that's going towards our common shareholders plus the portion that's going towards our preferred shareholders. So let's skip this number for right now and move on and figure out what amount of liability we have to create. And the first one is going to be to dividends payable to our common shareholders. Dividends payable common liability account going up. Well, how do you figure out how much you're going to pay your shareholders? Well, it's the number of shares that you have outstanding at the time times the dividend rate that you're paying. Well, the dividend rate is given in the problem. It's 15 cents per share, which means we need to go back and we need to figure out how many shares are outstanding, which is the number of shares the public right now, at the time we're making this declaration, currently owns. And we can figure that out by going back through our journal entry over here. We authorized common shares to start with. Well, authorizing isn't the same as issuing, so let's not worry about that guy. Authorized shares aren't going to factor into our formula. Here, we issued some common shares, which means we definitely need to account for that. We issued 20,000 shares of common stock. So at that point, the public owned 20,000 of our shares. We had 20,000 shares outstanding. The next one was preferred stock. That's a different class. We'll get to that in a minute. Down here, we issued another 50,000 shares of common stock. So if we issued 20,000 in the first entry and 50,000 here, at this point on February 1st, Squeeze shareholders owned 70,000 shares. That was the amount of stock we had outstanding. Well, on March 1st, we purchased back 10,000 of those shares. Since we purchased them back, they're no longer in the hands of the public. They still count as shares issued, but they're no longer shares outstanding. And that means that those 10,000 shares we bought back of the 70,000 that were out there is bringing our number of shares outstanding down to 60,000. And now when we declare our dividend over here, that is the amount of shares we're going to use for our calculation as our shares outstanding. We have 60,000 shares that are currently in the hands of the public. We are paying a rate of 15 cents per share for our common shares, which means we're now liable to pay our common shareholders $9,000 in the future because we declared this dividend on common stock. For preferred, we have to create a liability even though we're not actually paying it right now. I can spell preferred, there we go. But we're going to use a different formula to get there. The formula to figure out the amount of dividend you have to pay for preferred is the number of shares outstanding times the stated rate on your preferred stock times the par of your preferred stock. And that section right there will tell you how much you have to pay for the year, because the rate is always expressed in terms of yearly. Well, we're not paying a yearly dividend here. So at the end, when we figure out the yearly portion, we're going to multiply it again by the portion of the year that we're actually paying a dividend for. to figure out what is our amount of dividends that we are saying we're going to pay for this portion of the year. So let's go back and find our information. On January 3rd, we issued 15,000 shares of preferred stock. That was our only issuance. We didn't buy any preferred stock back, which means all 15,000 shares at this point are currently outstanding. Well, those 15,000 shares have a stated rate of 5% and a par value of $100. So if we go and we take 15,000, multiply it by our stated rate of 5% or 0.05 and multiply that by our par of 100, we're going to come up with 75,000. Well, that 75,000 is for the year, because the stated rate is always in terms of for the year. They're giving out 5% dividends equal to 5% of par value each year, but we're not paying an annual yearly dividend. Our information says that it is a quarterly dividend. So what we can do is we can take that 7,500 and multiply it by the portion of the year we're paying for. Every quarter is 3 months, so let's multiply it by 3/12. And when we do that, we come up with 18,750. Or if you wish, you can just divide that 75,000 by 4 to get to the quarterly amount, whatever makes you happy. In total, though, we know that we are declaring $9,000 of dividends to our common shareholders and $18,750 of the dividends to our preferred shareholders. So the debit to cash dividends is just equal to the sum of those two numbers, which is $27,750. That is the amount we're going to have to pay in the future when the payment date rolls around. And in this entry, we declared cash dividends. Coming up next, Squeeze is going to sell some of the treasury stock that they had previously purchased, and they're going to do so at a rate of $22 per share. On March 15th, we got to set up our entry first, and the first thing we know is that we are going to be receiving cash. We wouldn't be selling these shares to the public if we weren't getting something back. What we're getting back is cash. And to figure out how much cash you're receiving, you take the number of shares of treasury that you're reselling to the public and multiply it by the market price you're selling it for at the time of sale. We're selling back 2,500 shares. The current market price is $22, which means the public is paying us $55,000 for this treasury stock when we sell it back to them. Well, we need to take our treasury stock off the books. So our first credit is going to be to treasury stock common. As a contra equity account, this account increases on the debit side and decreases on the credit side. The rule of thumb with treasury stock is whenever you take it off the books, you need to take it off at the per share cost basis that you put it on the books for in the first place. So yes, we're selling this for $22, but how much did we originally pay to buy this treasury stock back just a couple journal entries ago? On March 1st, when we initially bought these shares back, we bought them back at a price of $18 per share. That was our cost basis for these common shares we had in treasury, $18 a share. Well, that means that these 2,500 shares that we are selling right now, which originally cost us $18 a piece, cost us $45,000 in total to acquire. And now we know that in this entry we are selling for an amount of cash which is higher than the price that we paid. We're earning a profit on this sale. And we need to record that profit, obviously, because our debits don't equal our credits. And the amount of profitability that we made from the sale of treasury stock is recorded in our paid-in capital in excess of par from treasury stock transaction account, or PIC Treasury for short. And we know, looking at this, that the difference is $10,000. But we can be thorough and we can go through and throw it into a formula to make sure that our numbers jive, that they're correct. Because we can find the amount of profit that we made on the sale by taking the number of shares that we are selling and multiplying it by the difference between what we sold it for and what our cost basis was. Well, we just sold these for $22 a share. Our basis was $18 a share, which means we made $4 per share profit, and on those 2,500 shares in total means we're going to make $10,000. And now our debits equal our credits, so we know our journal entry is good. In this entry, we'll recorded the sale of treasury stock at a profit.